FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and who would have thought that one day you would live to see oil selling at negative prices, oil being worth more in the ground than delivered? Well, that's what we've seen yesterday, and it's still going on today. And let's see what Danielle Park has to say about that. But first, as always, we want to hear what you think about it. Email us, kl@kerrylutz.com. That's kl@kerrylutz.com. And make sure you check out Danielle's site, jugglingdynamite.com. I guarantee you'll learn things from that site that you never knew, that you didn't even believe were possible. So Danielle, it's great to have you back as always. And what is your take on what's happening in oil and commodities here?
Yeah, so I think we're finally getting some recognition of the extent, the gravity of the recession now unfolding around the world. There's a bunch of factors at work here. I think in the initial phases of this, January through February, there was widespread disbelief or a sense that the virus was some kind of a, fringe issue that would pass quickly. And I think that as it has spread, as consumption has plummeted, as financial assets have had to reckon with both the incoming parade of negative earnings, disappointing forecasts, all these things that should impact financial markets. At the same time, a deluge of central bank liquidity, flooding in, which is the same old that we've been dealing with for the past many years. And so real economy things like not just oil, Kerry, but copper, silver, palladium, things that are used in the real world are in a major downturn again in the past few days. And it was surreal yesterday. I have to say, I was working away, and every time I looked up at it's the May contract that was expiring April 21st, the May contract for WTI. And, at one point I looked up and it was $10 and then it was $8. And the next thing you know, it went, as you know, deep 37 negative, which is just a mind-boggling thing. But really, we shouldn't be surprised because we have such severe dislocation and interruption of free market forces. We've had such forced speculation in recent years. As I was writing on the blog, whether it's, we've seen this in this superfluous pileup of all these things that have been financial demand, but not actual real world demand. And so even when you've got cuts, the big 10 million barrels a day cut that President Trump was boasting about last week, but in fact, with the drop in demand globally, there's still some 20 million barrels a day being produced superfluously and piling up. I remember a really cool story from an old trader friend of mine who back in the 70s was talking about how his statement was, you never know how low something can go until it goes there. And his story was about the price of sugar. And he was talking about how sugar had got so, financialized and overtraded and levered in a speculative, boom in the commodity sector in the 1970s. And then what happened was once everyone had bought and prices were so far and stores were so far above where demand was, the price started to drop. And of course, the traders start dumping it and the hedge funds start dumping it. Everyone is trading it. And ultimately, the price goes so low that they ended up cutting up the bags and throwing out the sugar and selling the burlap as a more valuable commodity than the actual sugar itself. And so, of course, did the world stop using sugar at that point? No, of course not. It's a question of how much surplus supply and how you can store it. And that's exactly what we're looking at right now with the price of oil.
Yeah, I absolutely remember exactly what you're talking about. That was when I first got interested in commodities. The play there was to buy, it went down to a penny a pound, which basically in the United States, in Hawaii, that just ended sugar production altogether. But of course, in Florida, in my county, Palm Beach County, we have these lush government subsidies, so that they never stopped producing it here. And to this day, the largest export of Palm Beach County is sugar, and it goes out of the port of Palm Beach. But I don't want to digress. But my point is, every dog has its day, and eventually it went up to 12 cents a pound and even higher because the supply was so dramatically reduced. But it really injured those lesser developed countries that really relied upon it, such as Cuba and other countries in South America that were producing it at the time.
And make no mistake, this plunge in oil is definitely devastating for Canada, for sure, and for many emerging market economies that have been selling commodities in U.S. dollars and using that cash flow to cover their expenses and pay their debts, which are often owed in U.S. dollars. So this evaporation of cash flow, which is absolutely what it is coming at a very difficult time. And that is just magnifying the recessionary impacts, which are already fully blown around the world.
Yeah, couldn't agree more. And I remember I saw similar kind of patterns in late 2000 to early to mid 2001. And I remember I was talking to my friend and I said, this kind of reminds me of some patterns I saw in the lead up to World War I. And, what I am taken from this is war drums. We see China being demonized for how they handled the virus and concealing information and such. I just see that these types of dislocations often lead to international tensions, scapegoating by countries, and inevitably to war. And I'm not predicting it. I'm just saying there's a similarity here, and we could be trading up to a war. And when you look at the way markets go, like in 2001, in 1913, 14, and 15, you kind of saw these weird gyrations in the market, and they didn't really know until after World War I started that the markets were signaling this. Whether it is or not this time, I don't know, but I think it's worth noting.
I would suggest that whether we get into a military conflict or not, we are in the midst of a virus war at the moment, for sure. And it's, it's this struggle between how do we open up economically, how do we keep cash flow moving around the world while we're trying to block the transmission of this virus. And of course, that is where you're getting these very defined positions. Some people are very, adamant that we need to vote in favor of the economy and opening it versus trying to protect against the spread. And others feel very strongly that if we don't control the spread, there won't be any economy, to function in any event. So you've got this push and pull between these two forces. And frankly, none of us knows how this actually unfolds. So my point is simply that as a risk manager, I didn't know that the pandemic would be the thing that would trigger all these dominoes, right?
No one could have known.
Although that was certainly a pandemic has been on the list of potential threats to the world for a long, long time. Obviously, it should be on the list at all times, but you just never know when or if one will be within your lifespan. But the thing that really is the aggravating feature here, and I've talked about this so much, but it is that we came into this with, the 90th percentile of asset valuations, the most rigged financial system juiced on speculation and inputs from central banks that have been super reckless and just enforced all the wrong behaviors. I noticed today, so we've been talking for a while about buybacks and how buybacks were the juice that really, pushed the S&P in particular higher over the past several years, because even the Russell 2000, the small cap stocks in the U.S. have actually been in a downturn since September of 2018, Carrie. So it really was, 2018 was the peak of the profit cycle. It was the peak in economic growth in the U.S., and it was the peak of the small cap index. And we've had downward movement ever since. The decoupler was the S&P 500, and that was because of companies buying back their shares. They became the only net buyer of those particular instruments, and they drove the price higher, which allowed more leverage to go off of that. Now, the thing is that that is all reversing now, and the companies that levered themselves up to do that are doing things like today, a big story that many companies are canceling their matching program. So, in 401ks, how employers will match contributions, they're now canceling that program. This is 2 months into this supposed, from a peak in the S&P 500, these large multinational companies that ought to have big store chests of cash built up because they had the longest recovery and the most help and the most bailouts and the most central bank gifts of any cycle in human history, right? And 2 months into this downturn, they're already doing things like canceling any contribution matching from employees. So my point would be that if they are trying to do that now, then anyone that bought back shares in the last year, any company that bought back shares should not be allowed to cancel matching, for example, for their 401k plans, and should have clawbacks of executive compensation. I mean, it's lunatic fringe. The disparity between that C-suite and the stock options that they've been compensated with and the average worker has become just grotesque. And that is a large part of why we are so unprepared for the financial challenges which are presently at hand.
That's such a great point. I don't know if you caught my article that I sent out. Basically the taxpayers' bailout Bill of Rights, but they should be made to pay for this, and the companies getting these bailouts, especially Boeing, but the airline companies and all the companies, they bought back $4.5 trillion worth of stock, Danielle, since 2012. So to me, at the very least, what should have been done in these bailouts, they actually incorporated some of the things that I recommended. Now, I'm not claiming responsibility for it by any stretch. I think maybe I was just stating a lot of frustrations by a lot of people. But for one, I think if a company takes bailout funds, that the entire senior management, the top 5 people, should be forced to resign immediately, like it should have been with the banks when they took bailouts. In addition, no more buybacks, which is actually incorporated in the bill. They can't do any more buybacks until a year after they pay back the loans. In addition, no lobbying, and compensation should be set in the form of monetary bonuses based on free cash flow and real earnings per share. There was a bunch of other things I had in there as well. And also probably, things like you said, don't cancel the matching and don't cancel the company Christmas party. That's what they're going to be doing next,
Well, what we really need to do is have a buildup of savings in the general economy. And while that is good for specific households, it will be continually difficult for GDP growth. That's a headwind that we must face. Because we've magnified everything on the upside in the leveraging up period, we now have to take the hit in terms of slower growth in this environment going forward. And I've said this for a long time. The part of the solution here is lower oil prices. So ironically, yes, very difficult for countries that are dependent on exports like oil for their cash flow. But on the other hand, it is a tax, let's not forget. And yes, ultimately for the consumer who is cash strapped here, who has been looted for the past 20 years at every possible turn, we need them to repair their balance sheet. So I was writing about, Nomura's chief economist, Richard Koo, who is he's been writing about what happened in Japan because he was an expert there on the ground since about 2003. So after their big asset bubble burst, their housing bubble and their stock bubble burst in '89, Japan stepped in with all sorts of similar measures to what the playbook has been from the Federal Reserve over the past 10 years. And he wrote this book in 2003 called Japan's Struggle with Uncharted Economics and Global Implications. And it really is the story that's unfolding now on a global level. So he points out that when you have a balance sheet recession, which is what we have today, because we have this evaporation of cash flow, a sudden stop, which reveals the fragility of a system which has too little cash and tons of leverage, right? So now you get asset prices beginning to fall and having to be sold under stress, which pushes down prices, at the same time as you have the liability or debt side of the equation actually getting larger, right? So what you have to do to correct that is ultimately to pay down the debt through defaults and through actual retirement, through payments, through paying it out. So the next phase, it takes much longer to recover from in a balance sheet recession. It's a messy, painful process, but it's absolutely essential to restarting sort of seed corn, stored energy in the economy, in the households. And so what I think the solution is in this environment is that you can't pay executives the compensation in shares is now no longer going to be the main metric. It's going to be compensating them in, for example, debt of their own company. Why? Because then they will care about the credit quality of the balance sheet. And we must get the focus away from how do we get a share price up at all costs to how do we rebuild financial strength in companies, households, and the economy in general. So this will be a longer term prospect, but it is essential. And I think that that's, when you look at his work, and I put some clips of him in interview in the last few years, he explains it quite well why this has always been the case. It was the case after 1929, and it was the case after Japan's big bust.
I couldn't agree with you more. Hey, as I was meditating this morning, and I hadn't done it for a couple of days, so I really had to get it in. I've been meditating for years now. I came up with Lutz's law of unsustainable trends. And here it goes.
Was this during your period of mindfulness and peace, or was this afterwards?
It popped into my head while I was thinking of it, while I was meditating. You're always kind of fighting with your thoughts and trying to not think and all that. So the law of unsustainable trends. A trend that is unsustainable will eventually stop and even reverse at an unknowable point in the future. A trend in motion continues in motion until it becomes unsustainable. And then examples like the U.S. economy, the debt, the trade deficit, the coronavirus epidemic, population growth, China's economy, and you could just go down the list. There are so many trends that we know are unsustainable. And we always say, well, a trend in motion stays in motion until it stops. But the reason it stops is because it becomes unsustainable. And unsustainability is really the byword of the global economy at this point. So if anybody ever argues about the value of meditation, don't, because I've gotten some of my best inspiration from it. And I think we've been living in unsustainable times. You and I have talked about it for years now, and everybody said, well, it's working now. It's going to keep working until hopefully sometime long in the future when it doesn't. But the fact is that eventually they all stop.
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near two producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold two companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Well, and you give back all the apparent, the appearance of prosperity or progress that was made in that speculative frenzy actually gets taken back very quickly. And we've seen that already in Canada, where the stock market evaporated, the last 10 years of growth in a matter of 1 month. That's typical of these periods. And I think your S&P 500, because it has been so incredibly manipulated and juiced with all these activities, I think it's even more vulnerable this cycle than it was in the last two, which saw it lose 50% of its value. Gary Schilling has been around a long time as an economist and a money manager, and he was out with a note this morning saying that he thinks we're following a 1929 style mean reversion episode here in asset markets. And the average bear market, the median bear market lasts 13 months, Carrie. Mm-hmm. We're like 2 months into this one. Again, when you're in this percentile of overvaluation, historically, there's only been 3 other times, and both of those times the loss cycle was 50 to 86% of the value. So, we'll get these big drawdowns, we'll get retracements and bounces, but it's on a longer journey. This is not a quick V-style economy recovery, and it's certainly not for the financial markets, in my view. I think this is going to be a long, sort of fight, and so far people are still conditioned looking to buy the dip. We've seen that with the oil stuff. People plowing in the retail funds were plowing into the funds, ETFs that were derivatives of oil in the last few days. Mm-hmm. And then that dropped suddenly this morning. I think people still have in their mind, how do we trade this? How do we win some money? Because they are so deficit in savings and actual, something to lose, so to speak. They're very little to lose. And so they keep trying to take really extreme risks. But I think ultimately at the end of this cycle, we're going to see that impulse is quashed completely, and people sort of throw in the towel and go back to, what can I do to actually support myself and to feed my family, and how can I sort of have a place to live? This is the tiny house movement. This is the integration of households. This is, it's interesting that Airbnb and all these rental places that have largely contributed to a huge supply of properties in the world, in every major city in the world, properties sitting empty, right? Except for the odd periodic income. Well, right now, they're not getting any income at all, right? The head of Airbnb wrote a letter to the Canadian government last week saying that 30% of Canadians say that they're going to go bankrupt if they don't get any income, or they're going to be evicted. Even the ones that are renters have been relying on Airbnb income just to cover their rent, right? So there's this whole episode of gig employees where no one was paying, into government pensions. No one was paying. Everyone wanted to be self-employed, and so to speak. Now what's happened, of course, is the income's vanished and everybody's trying to get government benefits. So this whole lesson learned is you can't take out of the pot if you don't put into the pot, So it's really, everyone hates government when they think things are going well, and then they all want government to save us when, all hell is breaking loose. And here's just one more stat that I think is very important here. So last year, just 1 in 11 people worldwide was over the age of 65, okay? 1 in 11. Over the next 30 years, Carrie, that number shifts to 1 in 6. So almost double the amount of people over 65 over the next 25 years. And that matters because that is a macro demographic trend that is not going to be, again, supportive of large gains in GDP. This is about how do we do things cheaper and more efficient. And this whole migration to nursing care, old folks care, the virus has really shown us how extraordinarily vulnerable aging people are, but also unhealthy people, overweight people, right? They're much more susceptible. Smokers, the cigarette companies are noting that they're selling a lot less cigarettes right now because people are aware that, hey, I have to be concerned about my lungs and its vulnerability to this virus. So I think in many ways, the virus, as awful as it is highlighting for us an opportunity here to see a lot of habits that we've been doing, which are so destructive, and make wiser choices. So I'm ultimately an optimist because I believe when people are quashed and suffer greatly from bad choices, that's a learning opportunity to make smarter ones.
Well, let's hope that they learn the lesson. It's funny you mentioned Airbnb. So I've looked at that model for years now, and it's been growing by leaps and bounds. I mean, any place you go, there's like hundreds of units available, and they all seem to be renting them. And I always said it's going to crash. But what's going to cause it to crash? Because just an economic crash or a recession will actually drive more people to Airbnbs because they're less costly. The lower end, mid end Airbnb is far less expensive than a hotel room. And here it is. We found out what would make it crash, a pandemic. And I don't know that it's ever going to be the same in places like Nashville. They had a huge building boom that was fed almost exclusively by Airbnb units. And in Florida here, I would just look in my area and look around and see what was there. And I had my choice of hundreds and hundreds of units. And that brings us to real estate. So real estate, right now, there is no real estate market because you can't look at a house. You could buy one if you're in the midst of buying, but nobody really wants to buy a house right now unless they absolutely have to. Like, they're probably going to rent, even if they're moving for a job opportunity, if that opportunity still exists. So housing, how's that going to recover from this once the pandemic is over? What's housing going to look like?
Well, I think there's a few things there. There's the incredibly high prices, which again were an issue and were juiced by cheap credit, speculative fever, and this preoccupation with short-term rentals, which allowed people to, keep fully furnished homes that were only rented for a week here and there, and were earning as much rent or more as they could rent on a full-time basis. So it took rental out of the pool, made it harder for people looking for a nice place to rent to live unless they could afford very high-end rents. So it really caused this great distortion, and incentives were to overbuild, certainly in Canada, in condos and things. We had massive overbuilding in the condo market in places like Toronto and Vancouver. And so what's happened now is that this full stop in income has hit both the owners and renters can't pay income, then owners can't pay mortgages. Most of these activities are highly levered. The banks are having trouble finding people to loan money to, even though the governments are saying, hey, we want you to, here's cheap money, here's some more. We want you to extend loans. Banks are saying, well, people don't have income, so we can't just turn around and give them loans. Well, they did do that in your big blow up in 2006. As you know, there was liar loans and all sorts of things going on. But basically in Canada, we've got a massive oversupply now and too expensive. So I think the demographic issue is going to be more boomers wanting to downsize, to get rid of properties because they need to raise cash. The hit to their retirement savings again, which is happening right now and is still in motion, is going to make it abundantly clear that people don't have the income or the assets that they thought they did. God forbid, some of them still have debt. So the debt is there, but the asset values are plunging. So this all speaks to more interest in selling and downsizing, consolidating, smaller places to live, cheaper places to live, multi-generational families. And that's just going to underline the oversupply. Also, pulling in the international travel aspect, the less immigration. Let's face it, this is a very protectionist time we're moving into here, where there's a lot of pulling in and saying we don't want to have, as much immigration as we've had in the past. And you can argue for and against that. The reality is that's the sentiment of our time. And that's going to continue to be a headwind as well in terms of new buyers in these markets. So I think we've really set up for this perfect storm where even after, and let's face it, this virus is going to be here for a very best case scenario. We can get a vaccine perhaps in a year and a half. That would be a record pace, by the way. The polio vaccine, which was considered the fastest vaccine that was ever created, took 4 years, Carrie, to come up with. Mm-hmm. And we've got a few possibilities here in trials. But unless we get this, and even then, we're going to have a long plod back from this sudden abrupt stop. And, how long will it take for people to feel comfortable with spending money, with entering into contracts for levered real estate, with, renting expensive apartments again? I think it's going to take a long time. And that's to Richard Koo's point, and that's to what we're seeing in China. Even after they're starting to reopen their economy, only 25% of the people surveyed said that they were choosing to go out for any non-essential purpose still, even after they're supposedly no longer on lockdown. So I think it just, people are feeling the vulnerability of their condition. and they are changing behavior as we speak. And that behavioral change suggests, typically in other examples, it lasted a couple of decades. It didn't last a couple of months. And so again, I think it's ultimately it will be healthy, but in the short run, it's going to continue to be very challenging.
Yeah, well, I think we'll see about the virus. It appears to have passed its peak here in the States. You can't really get good information on reported cases and people who are actually being hospitalized, but we've seen those numbers dip, and the mortalities appear to have peaked here as well. I know in Florida, we're doubling at the rate of, they said as of yesterday, it was around 20, but there were 1,000 new cases in the past day. There's 27,000 cases. So that means every 27 days in Washington State, which was the epicenter, the first state to really get hit hard by it. There's in Seattle, King County, there are too few cases to even calculate a doubling rate. So the worst of it, but again, that varies from state to state and country to country.
And also in Ontario where I live, they think our infection rate may have peaked as well in terms of the spread, but that's because everybody's been locked down in their house for the last 8 weeks. I mean, as soon as you start trying to reopen activity, which everyone's hoping for in May, right? By mid-May, they're hoping. But I noticed, for example, in Toronto this week, I think it was today or yesterday, they announced that they're going to cancel all major gatherings till the end of June at least. And this is just this recognition that, and this is what we're seeing in places like Singapore and Hong Kong and other places that got on this early, locked everything down, and even in more draconian ways that we've done in North America with our civil liberties here, they are seeing the spread start to pick up again as soon as they relax those norms. And so I think this is my point, is that this is not, like I've said this before, it's not a tornado that happens today and tomorrow it's sunny and we go back to work. It's this sort of thing that haunts us and recycles and moves through. And that is why I think it has the potential to change behavior significantly, because it will haunt people and they're going to continue to be very concerned. I mean, as my point was, they were very vulnerable well before this hit, but now that their income has had this big stop and their savings has had a big hit, they're really suspicious of how vulnerable they really are now. And it's starting to become readily apparent.
Now they know they're vulnerable. They always were. They just didn't know it. We'll see how the virus runs its course. There's a lot of different theories out there and a lot of number crunching taking place. But the gear up to it, even like in New York, which is the epicenter now in the United States and probably the world, hospitalizations down, the number of beds, ICU, an emergency room. They had all these provisional hospitals that have gone empty, that they're shutting down. So according to one Israeli biostatistician, wherever this thing hits, it lasts for 70 days and then it diminishes. So hopefully he's right, but that doesn't mean it won't come back in the fall. But hopefully at that point, we will have some effective or more effective treatments than we have now. But it doesn't even matter at this point, because it's really not about the virus. It's about what you and I have been talking about for the past, I think it's 9 years now, Danielle, or close to it. We've been talking about this, sounding a clarion call. It's kind of like Paul Revere, if he rode down the streets, where was it, in Massachusetts, in Revere, I guess, Boston, greater Boston, if he was just ignored when he was riding down the Paul Revere's trail, everybody just turned their back and went about their business, and then the British invaded anyway. Well, if it wasn't the coronavirus, Danielle, you and I know it was going to be something else. This thing was always going to happen, and this is just the catalyst. Well, we're going to know more about it next week, or in 2 weeks when we speak again. And just go check out Danielle's site, jugglingdynamite.com. Email us, kl@kerrylutz.com, kl@kerrylutz.com. And go visit the site, financialsurvivalnetwork.com. Believe it or not, Danielle, I was really considering changing the name of the site. I was feeling like I was becoming less and less relevant by the day. And now I'm really happy that I didn't do it.
Let me tell you, Carrie, financial survival will be relevant for the rest of your life and for the rest of humanity's life, because it is always under threat from human behavior and crazy central bankers and people selling debt and risk who always want to ramp up people's exposure. And it's always going to be, life is full of shocks of all kinds. And so that is why our work will always be valuable.
And amen to that, Danielle. We'll talk to you in a couple of weeks.
Okay, Carrie, thanks.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.